Okay, guys, we're going to go ahead and get started with the economic trends from the One Big Beautiful Bill, and really, it's a little bit bigger than that because it's really the what I expect economically as a result of the One Big Beautiful Bill, and a lot of the other government action. Because there's a lot of things happening, and a lot of things has happened with the government, right? We have the One Big Beautiful Bill, this tax stimulus, right, which is pro-growth tax reform. They feel like it's going to add 0.2% to the annual GDP growth from 2025 to 2027, and possibly 0.4 to 1.1% higher long-term output. Things that are also going to impact the economy. And really, there's kind of a four-pillar growth strategy that the government's engaging in order to try to help the economy to grow. Also, a lot of deregulation, okay, reducing compliance burdens. They're putting like $100 million to the Office of Management budget to try to go ahead and do rule reduction. And some of the executive orders are, for every one rule that new goes in, they have to take out a number of other rules that are already in there. And obviously, you have the tariff situations. A lot of people have talked about. The economists are having a tough time figuring out what's really going to happen with tariffs. It's the challenge, a big challenge for the economists because it's kind of unprecedented territory, and the economic models are really not grasping it. And then, of course, the fourth thing they're trying to do is trying to lower interest rates, right? And we can expect some increases in GDP as a result of lower interest rates. In fact, really what we're looking at a gross domestic product increase from 2026 of 1.6%. And we're hoping to see the Fed cuts rates by about 2 percentage points into 2026 and beyond. So your long-term yields can get in the 4.5% rate. But when you look at each one of these, the tax stimulus, the deregulation, the tariffs, and I want to talk about each one of those, and the interest rate reductions, I think those are all generally massive government action to encourage growth in our economy, right? New tax policy permanently enhances and growth-focused provisions such as a 23% qualified business income deduction, raising it from 20%, 100% bonus depreciation, and a higher 2.5 million in Section 179 expensing cap. One analyst estimates the QBB, the OBB, One Big Beautiful Bill. We're looking at 0.2 percentage points annually between 2025 and 2027, which is 4.4 to 1.1% higher by 2034 relative to baseline projections. It really creates powerful incentives for capital. Also, R&D and the changes in the R&D investment numbers is going to encourage more R&D and more family business continuity in some of these changes. And then the growth rate, the deregulation, the administration's deregulation drive includes a 10-to-1 rollback so every new rule, which we just kind of talked about, 10 must be eliminated, right? So by mid-2025, the Federal Reserve's registered rule count hit historic lows, right? So it's working. The EPA budget was cut by 65%, including suspension of many climate rules. The WB further provided $100 million to the Office of Management budget for regulatory review office to accelerate deregulatory reviews. This directly lowers compliance costs, allowing faster business expansion in sectors such as energy, finance, and administration. I'm going to talk a little bit about this. Tariffs and immigration. I mean, we've effectively shut down the borders. We had some higher tariffs. It's hard to predict, what is going to happen with the tariffs in terms of because they're still really being negotiated. Some people think that there's going to be some estimated price increases at 2% on steel and 1.6 on aluminum, costing roughly about 650,000 per job saved in protected sectors. Immigration parallel restrictions have reduced labor inflows, tightening the workforce. Together, tariff and immigration curbs protect domestic producers, but also raise costs and shrink the labor pool and pressure export competitiveness, a mix of growth orientation and kind of an inflationary drag, right? Because you're fewer people, you may have to pay more for the people. Maybe real wages per person will also increase. Monetary policy, Federal Reserve alignment. The Federal Reserve projects real GDP growth at 1.6% in 2026, 1.8% in 2027, even after factoring in the One Big Beautiful Bill's stimulus. Policy still Policy rates still above 4% in 2025 are expected to decline to 2022.25 by the end of 2026. Treasury yields are around 4.5%, mortgage rates are near 7%. While the Fed remains cautious due to inflation risks, its gradual rate cuts effectively align monetary policy with fiscal pro-growth. I mean, we're seeing a cooling in the labor market. A week and a half ago, Jerome Powell finally said that, hey, we can't just think about inflation. We have to think about the job market as well. So everybody's expecting a rate cut in September. We don't know how significant it'll be, if it'll be a quarter point or what have you, but I think there's going to be some movement in that direction. And, like I spoke to one gentleman yesterday who's in the mortgage banking business, and he's basically, yeah, the Fed's always 6 months behind what they really should be doing, right? So let's focus on the One Big Beautiful Bill and then the changes in the One Big Beautiful Bill that's going to encourage economic growth, right? Tax credits, we have the deductions for qualified business income goes from 20 to 23%, permanently extends the QBI deduction. Remember, that was scheduled to sunset in 2026, and widen the income phase in from 75,000 single to 150,000 joint, $400 minimum deduction for over $1,000 of QBI, indexed, and that's indexed from 2027 on. So as inflation increases, that QBI deduction will also index, okay? So, and really, the economic outcome is stronger tax relief for pass-through entities, improves cash flow, competitiveness for small and mid-sized businesses. Because that QBI is used by a lot of pass-through entities like S Corps and LLCs and so forth. The estate and gift tax exemption, which was set to go down to 6 million, it was at 12.9, has permanently raised to 15 million, 30 million joint in 2026, and after that is indexed annually. So it's a significant increase in that gift tax and estate exemption, which should help family-owned businesses to do proper planning for succession, right? So, and it's going to help them with liquidity of succession because, I mean, if your asset base is under 15 million single, 30 million joint, then you're looking at a situation where you're not going to have any estate tax, death tax on the assets, but above that, there's that 40% estate tax, so it can be pretty significant. You have a lot of credits when it comes to employer-provided child tax credits. You can take up to 25% of your qualified child care credits that businesses offer child care support to their employees. Interesting opportunity there. Also, credits for paid family leave, 12 to 25% of wages paid. If you are offering paid family leave and medical leave credit, you can take those credits, get tax credits for that, right? It also allows the employer to make payments of student loans up to $5,200 annually tax-free. So this is pretty interesting, especially if you're a family-run business, you have kids that have gone to college, and you want to help them pay off their loans from your business. You could set them up as a small employee in your business and then contribute to pay off some of their student loans, right? So this is going to help people attract and retain skilled workers and reduces financial stress on employees. It's tax-free money, so it's always good money to have. They have HRAs, health reimbursement arrangements, which allows people, an employer, to not necessarily offer a straight-up medical plan, but offer a reimbursement arrangement instead, which allows the employee to go out to the marketplaces and get whatever coverage they want and then get reimbursed from their employer. Cafeteria plan insurance expands the eligibility of a cafeteria plan for benefits. Employer credit for choice arrangements creates a new employer credit that reduces the cost of offering flexible benefit plans to your employees. We also have the special depreciation allowance extends bonus depreciation. We're back to 100% exempting, and Section 179 is up to 2.5 million. And this will encourage additional capital investment and business expansion. A lot of people during the 2017 tax code this encouraged a great deal of investment, right? Depreciation for production property. This is really probably one of the most interesting elements in the Big Beautiful Bill, which is 100% expensing of production property. So if you buy a plant, build a plant between July 4th, 2025 and 2030, you place it in service by 2024, you can write off that entire building and everything you put into it in 1 year. Okay. So 100% expensing. So imagine you buy a building, you make it into a manufacturing facility and being able to write off the whole building instead of waiting 39 years. It's pretty impressive. Low-income housing credit, again, to make more housing available, modifies and strengthens the low-income housing credit allocation, program, expanded allocations for credits, 9% and 4%, incentivize real estate developers and hopefully increases affordable housing supply while creating construction and service jobs. So overall economic impact of the bill is pro-growth, a shift that strengthens business investment through special depreciation and accelerated expensing of production property, right? Preserving family enterprises. So you look at all of these things that it's really doing in there. And when you back up and look at the big picture, and everything that it's offering, it's really hoping to increase business investment to expand the economy, right? So, aggressively buy new equipment, production. Yet what they're really looking to do is bring manufacturing back and expand manufacturing, which I think is going to be great. And support community development from affordable housing. So this is all good. Health and medical. HSA contribution limits have been expanded so that people can use more HSA and save money for medical expenses. You have on-site employee clinics, employer costs for on-site medical services excluded from taxable income. So you can basically have on-site clinics that are excluded from taxable income. You also, gym memberships and so forth, if you want to offer those to people, you can do that on a tax-free basis, essentially to the employees. It's treated as deductible medical care, so it helps to emphasize wellness, right? Again, these provisions, we're looking to a more healthier, more resilient workforce, and get that support from the tax incentives to help people get a little bit more in terms of healthcare and the wellness programs and everything else to help people be less taxed on their healthcare. Business tax incentives, deduction of domestic research and development expenditures, full expensing of R&D. Very, very interesting. I actually had a client this week that had R&D over the last few years, and they had to set those up on 5-year amortization to get the R&D tax credits. Well, now we can go back and recoup all of those losses that they had. All of those expenses that they had set up as amortized expenses, we can now take them immediately. We can actually go back for several years. I think it's go back 3 years and take those R&D expenses. So this actually is going to help save them quite a bit of money on their tax returns. And this, you get the R&D tax credit, you get to write everything off right away, which is going to encourage innovation and boost US-based R&D activity. We have, the Section 179 at 2.5 million with a phase-out threshold beginning at 4 million indexed for inflation. Again, improving cash flow, supports investment in technology and new equipment. Renewal and enhancement of opportunity zones, extends and strengthens the opportunity zone tax credits, tax benefits, lower eligibility periods, expanded investment incentives in distressed area, and stimulates local economic and development and job creation. I mean, they also want to do these opportunity zones in rural areas as well. So this is another pretty interesting development, especially if you're into real estate investing, right? R&D incentives. We kind of already covered this, but modified ATI calculation for business interest deduction allows the cost of financing for some of these R&Ds, making it easier for business to borrow to expand. Okay, so it's basically freeing up some of the immediate expensing of interest on certain development projects. And we talked about the full deduction of domestic research expenses and immediate write-off of R&D costs, which is pretty good. Um, the gross receipts threshold for small manufacturing raises eligibility threshold for small manufacturer status. This small manufacturer status lets you do a number of things in terms of how you qualify for certain benefits, and also things like the 1202 election, which allows you to um, avoid taxable gain on the sale of your business. So it expands access to simplified accounting and tax benefits for more manufacturer, de minimis rules for third-party network transactions. And that's the 1099-K, right? So it's repealing some of the provisions requiring 1099-K reporting from things like Venmo, and it really has higher reporting limits on the 1099-K. So it really reduces compliance burden on small business and gig economy participants. The threshold for reporting information also has been raised, increased the dollar threshold for 1099 reporting. I believe it's up to $1,000 now. It was previously at $600. So should simplify some accounting. Key takeaway again, provisions collectively strengthen the U.S. competitiveness by lowering costs of investment, research, development, compliance by expanding deductions for R&D. Remember, we get the tax credit, but now we can actually write it off at the same time, and enhancing opportunity zones. The bill drives innovation, capital formation, community development, small business and manufacturing incentives, and reduces reporting burdens and expands access to simplified tax treatment. So they want to encourage businesses to invest more in R&D, expand into underserved communities, scale manufacturing operations, and reinvest savings into reduced compliance into hiring, innovation, and expansion. It's really what we're looking to do. Energy, a lot of the energy credits are being terminated in order to pay for some of the other part of the big beautiful bill. And it's going to be very, very interesting, like the termination of energy credits for home improvements, and for solar things, the termination of residential energy credit is probably going to, change the entire solar industry. And I've talked to a lot of people in the solar industry. They're not really that worried, quite honestly. They think it's going to encourage people to get more efficient in the solar business, right? They phase out. This is a policy pivot away from federal support for clean energy and efficiency investments. By eliminating or reducing the credits, electric vehicles, renewable energy, energy-efficient housing, the bill lowers short-term federal expenditures but raises costs for businesses and consumers investing in clean technologies. Essentially, you're getting rid of the government underwriting these technologies. Deregulation. So we kind of talked about the one big beautiful bill and the expansion. There's been a lot of deregulation that's been happening. And I think one of the things we can look to is back to a good example on deregulation and its impact to the economy. Is when Ronald Reagan came in. I mean, he effectively pursued deregulation on a substantial scale, right? So banking, transportation, energy, reduced government-imposed costs and restrictions, which helped stabilize prices. Combined with a tight monetary policy from the Federal Reserve, inflation fell dramatically when he was in office from 13.5% in 1980 to 4.1% by 1988. So inflation was gotten under control with these measures. After the recession from 81 to 82, partially triggered by anti-inflationary policies, deregulation and tax cuts contributed to a period of rapid expansion. So think about this, because we think about the 1.6% that the Fed is currently predicting for 26, 27. Between 1983 and 1980, the U.S. economy grew at an average annual rate of 4.4%. with the impact of deregulation compared to 2.8% in the previous decade. So that is a huge shift, right? That's almost, that's a 1.8% additional. And when you look at 2.8%, 4.4%, you're almost looking at 60% higher growth in 83 to 89, right? And really they did the deregulation in 81, 82, right? And some of it was caused by the tight monetary policies of the Fed in 81, 82, right? And then the economy took off after that. Once rates came back down again, the deregulation took effect and growth was amazing. So for those of us that remember that time in the 80s from 83 to 89, it was a massive boom time for business, right? And I think we need to look at this deregulation combine. And you got to remember too, they did the deregulation and then tax bill later to give additional tax cuts. Now everything is happening exactly at the same time. Really interesting. So I'm not sure what the overall impact is going to be, but it looks very, very, very positive. And I'm thinking that the 1.6% growth in GDP that the Fed is predicting in 2026, 2027 is going to be we could be in the 4% range. If this kicks in, this 4% kicks in, that's almost three times what they're projecting. So I am very, very bullish on economic growth as a result of all these massive government actions. We deregulated transportation, trucking, airlines, roads, spurred competition, led to lower prices. Sorry, railroads, not roads. Financial deregulation allowed banks and saving institutions more flexibility in lending, and energy deregulation helped reduce shortages and spur domestic production. Really, this is the freeing up the regulation really encouraged additional supply, right? So between 82 and 89, the economy added 20 million jobs. Medium household incomes increased in real terms as a result of economic expansion that lifted employment and wages, particularly in the mid to late 1980s. Stock market, I mean, this is going to sound ridiculous. The Dow Jones was 1,000 in 1982, and it was at 2,700 in 1987, reflecting, a tripling of the Dow in 3 years, right? There was some long-term risk involved with deregulation. We had the savings and loan crisis in the late 1980s from some overly loose financial rules. Income inequality widened as people took advantage of some of these rules, right? And federal deficits also increased at that time. So Trump had regulatory rollbacks and executive orders in January. He issued the Unleashing Prosperity Through Deregulation executive order, requiring every federal regulation enacted, 10 must be eliminated, and that the net cost of all new rules should be negative. So imagine that they have to calculate that any new rule has to have a negative net cost, right? So, and now they're going through in mid 2025, federal regulatory output hit record lows. The count of pages in the Federal Register, the number of significant new regulations both dropped to historic lows, signaling a steep pullback in oversight. The EPA, we talked about that. They actually did a bunch of stuff to increase supply in that area, rolling back climate and environmental regulations, slashing the EPA scientific research arm, and cutting its budgets by 65%. Nearly 70 coal-fired power plants were granted exemptions from pollution rules to help them continue to produce energy. And then they expanded executive funding of deregulation. It gave an additional $100 million to the Office of Management and Budget for regulatory review, empowering the White House authorities to centrally drive regulatory reform and sustain deregulatory momentum. Rapid deregulation spans multiple sectors: energy, healthcare, finance, environment, and technology, with the stated goal of unlocking economic growth by reducing compliance burdens and streamlining bureaucratic hurdles. So let's think for a second. We've got the one big beautiful bill to encourage investment and give businesses write-offs, and we have deregulation to encourage investment and expansion. Two interesting situations that both have shown in the past to increase growth, right? America First trade strategy, it's been in the news all over the place. People have an inability, I think was probably the best way to describe it, to forecast or predict what's going to happen as a result of the tariffs, right? They don't know if costs are going to go up or what's happening. And we know from, like I hear from not empirical data, but really from uh, anecdotal data that companies are actually switching from, like if the tariffs are high in China, they're going to go get stuff from Vietnam, right? Or if they're high in India, they're going to go to a different country to get the products that they need, right? So there's going to be a shifting of trade amongst trading partners. I think that's probably pretty clear. And again, it's not really set in stone, and nothing's set in stone yet. They're still working through it, right? So, we had the increase in China. We had a temporary 90-day suspension of select tariffs aimed at easing pressure on U.S. businesses and consumer. And, it covers a range of imported goods, especially from China, previously subject to elevated tariff rates. So again, things are up in the air, but I think the overall goal is to protect U.S. manufacturers and U.S. providers of goods by number one, giving them access to foreign markets and protecting them from inexpensive imports, right? So it's going to be interesting. Tech and SaaS subscriptions are vulnerable. Many essential platforms and software tools rely on international infrastructure. There could be potential problems on tariffs there. Imported equipment can have higher capital costs. Planning to buy computers, servers, or whatever, tariff resumption could mean higher replacement upgrade costs. Outsourced teams and contractors may have to adjust rates. If tariffs continue to increase and impact those areas, margins can get squeezed even without imports. Then we could have lower profitability, increased unpredictability in pricing, and maybe some tighter cash flow on that, but we don't know. Interest rates. I mean, this is probably, I think everybody that's watching the news is hearing about Trump's pressure on the Fed and Jerome Powell to lower interest rates. And interest rates are going to have an interesting impact on the economy, right? You know, there's been like in the last few years, the Fed started to raise some interest rates under Yellen and Powell amid solid growth of GDP at 2.3%. Then they started, as GDP continued to grow at 3%, they started raising rates more and more and more. And then the pandemic crisis happened and GDP collapsed and they dramatically lowered rates down to almost zero, right? So we had that situation in the pandemic where rates went down to zero. So it's kind of interesting. And then in 2022, you know, and really you think about, remember the government gave out $3.3 trillion in the pandemic, right? In a period of a few months, which is equivalent to 2 months of the gross domestic product of the United States, right? So you're taking every single dollar spent in the United States and like putting out another 2 months worth in 2020. And of course, that encouraged everybody had more money. So it encouraged inflation because inflation is essentially the supply and demand of goods and services, right? More money available, not as many goods. So what they decided to do to try to bring inflation in line, that they did the fastest rate hiking cycle since the 80s to fight inflation. CPI peaked at 9.1% in June and GDP was 2.1%. Rates became to a 22-year high and inflation eased to 3% and GDP at 2.5% in 2023. So now we're thinking the Fed is going to begin modest rate cuts as inflation moved closer to 2 to 3% and GDP slowed to 1.7. I mean, you really look at this and GDP growth is really following the interest rates and the changes in interest rates. And really, the Fed, in order to get inflation under control, is slowing growth in the economy. And really, what it does, and it really has this one tool in terms of interest rates to try to slow growth, to decrease demand, to decrease the demand on supply, which is going to put downward pressure on pricing. Because if you're trying to sell supply, and there's less money out there, you can't offer as much, so prices have to go down. So we kind of talked about this already. What they did And really in the pandemic, ultra low rates spurred massive borrowing, fueled stock and housing booms, and underpins financial stimulus, and was really a basic of the financial stimulus to keep the economy going during the pandemic. GDP had a huge increase in 2021. And then the 2023 Fed rate hikes were pretty substantial. I'm sorry, I jumped ahead. Whoops, jumped ahead there. It's kind of been a real roller coaster. I mean, I had so many clients that had variable rate loans through the SBA that, they went out and bought assets during the COVID time and got these loans. And then we get into a situation where we have interest rates hike all of a sudden in variable rate loans, so loan rates go up. And I had people whose payments for their businesses were doubling and dramatically increasing. So it really put a lot of people under pressure, caused a lot of problems with profitability. We're hoping that 2024 and 2025 really is we're seeing some. So I want to show you a little bit of a clip from Face the Nation, where it talks about what's happening right now with the Fed. And we'll take a look at this real quick.
And is the chief economic advisor at Allianz, and he joins us this morning from Greenwich, Connecticut. Good morning to you.
Good morning, Margaret.
So we saw the Federal Reserve Chair signal on Friday that the Fed is going to, as expected, begin lowering rates very soon. But he's also cited slowing economic growth and a cooling job market. So why then did the financial markets rally?
Because he finally pivoted to the risk that matters most for the US economy right now. By construct, the Fed has to deliver two things: maximum employment and price stability. And the Fed is looking at slightly higher inflation and a weakening labor market. And what Powell finally did, and many of us feel he should have done this earlier, is he said the risk to the employment side is higher than the risk to the inflation side, and therefore an interest rate cut is warranted. As you know, many of us felt he should have cut last month.
Mm-hmm. Well, the Fed chair said significantly higher tariffs are remaking the entire global trade system. Tighter immigration policy has slowed labor growth, and there are big tax and regulation changes you can't quite, quantify at this point. But it's a lot of uncertainty. Since economists have to build off of
Do you hear what she's saying there in terms of how she summarized that? All of these changes are big, they're massive, right? And it's really, where are you going to bet on the economy and what's gonna happen as a result of all these changes? The border, the tariffs, right? The tax changes, the deregulation changes. These are all huge things. And to me, it really is fascinating that we're in the midst of all of this. And the models, and I think they're going to talk about this now, the models have a hard time predicting this. And these are the people in the Fed are supposed to be the best economists in the world, right? They're all doctorates from wherever, Harvard, Princeton, Yale, whatever, smart guys. So, we'll see. But I think that comment was so interesting where she summarized those important trends that are happening. Whoops. Let me get back there.
We turn now to the U.S. economy.
Because he finally pivoted to the risk that matters most for the US economy right now. By construct, the Fed has to deliver two things: maximum employment and price stability. And the Fed is looking at slightly higher inflation and a weakening labor market. And what Powell finally did, and many of us feel he should have done this earlier, is he said the risk to the employment side is higher than the risk to the inflation side, and therefore an interest rate cut is warranted. As you know, many of us felt he should have cut last month.
Mm-hmm. Well, the Fed chair said significantly higher tariffs are remaking the entire global trade system. Tighter immigration policy has slowed labor growth, and there are big tax and regulation changes you can't quite, quantify at this point. But it's a lot of uncertainty. Since economists have to build off of models and data, How do you predict where we're going if basically he's saying, throw out your models?
So one of the problems is he hasn't looked forward enough. He's been very data dependent, and therefore he has tended to be late. Look, there is something promising in our future, and that is productivity enhancement that comes from exciting innovation in AI, in life sciences, in robotics, and other areas. We just have to manage a challenging few months in the period ahead. And if that challenge is mishandled, we will not be able to get the opportunities that we have that offset a lot of structural headwinds, and that includes high debt and high deficits.
Mm-hmm. I want to ask you about something we were discussing with Congressman Lawler just before you, and that is this unusual decision for the U.S. government to take a stake in chip maker Intel. That company's been struggling of late, and its CEO was criticized by the President of the United States. He was criticized by the chair of the Senate Intelligence Committee, Tom Cotton. President Trump mentioned all of that on Friday, and he said this.
He walked in wanting to keep his job, and he ended up giving us $10 billion for the United States. So we picked up $10 billion, and we do a lot of deals like that.
The president said the CEO wanted to keep his job, so he offered a 10% stake in his company. Is this signaling a new era for U.S. policy? I mean, central planning of the economy?
I don't think so, Margaret. Look, as the congressman said, it's good to send a message that companies will not get something for nothing. And that is what they've gotten used to since 2008, all the bailouts. And what the U.S. is saying now is which were paid back, but at the time, the government took enormous risk in many, many areas. The most important distinction, if I may here, is between ownership and control. Yes, the government can own 10%, but it must not control how this company manages its affair. Because once we go down that road, that is a really dangerous road, and that would eat away at what makes America really special, which is a dynamic entrepreneurial economy.
Mm-hmm. And I believe the Commerce Secretary said there won't be control, but that is something to watch for. I want to also ask you about political pressure, not just on the Federal Reserve Chair, which you've nodded to, but the president is also now threatening to fire Federal Reserve Governor Lisa Cook. They're accusing her without publicly disclosed evidence of mortgage fraud and urging an investigation. In fact, the Justice Department wrote a letter to Chair Powell encouraging her to be removed. Are you concerned that this is starting to be a pattern here of political interference with the Federal Reserve?
So these allegations are unproven, and it's important to stress that. Having just said that, this is the fifth time in the last 5 years that there has been allegations against a Fed official. And already 4 of them have had to resign. So what I'm concerned about is that there seems to have been a culture that has developed at the Fed that has resulted in these 4 resignations. But I am very worried about preserving Fed independence. An independent central bank is critical to the well-being of the economy. And there's lots of reasons for that. So, one has to distinguish between the two. I can't speak to the unproven allegations, but I do think it's really important to defend the central bank independence.
Well, as I understand it, the governor has said she wants to, share information and is denying wrongdoing here. But just the fact that it is the president directing the attention towards her, doesn't this suggest that even if Jerome Powell steps aside as head of the Federal Reserve, that this isn't going to stop this big spotlight on the central bank that is so powerful, and that the fear you have of political interference may not go away?
Yes, and my fear and my concern is that the longer Chair Powell is in his position, and it runs out in May, the longer he's in his position until then, the more this acts as a magnet for attacking not only deeper attacks from the president, but much broader from the political system. And that's one thing that quite a few people are worried about.
Mm-hmm. Mohammed Al-Arian, thank you so much for
So that was really, really interesting exchange. And if you think about the four things we're talking about, I think the missing link as of today is the fact that their monetary policy is not lining up with the other expansion policies we're working on, okay? Or the government is working on, right? Their work, the one big beautiful bill, the deregulation, the tariff situation in terms of restabilizing the American economy and giving, some better advantages to U.S. manufacturing. Um, you know, Monetary policy is the weak link right now because the rates are not being reduced, right? And we saw in the past how rate changes dramatically impacted GDP. So I think the pressure, and kind of like what Mohammed said, the pressure on the Fed is going to continue until the rates go down. Okay. So I think once Trump or the Republicans or however you want to talk about it, achieve the rate reductions that they want, and I think my gut tells me, just from 40 years in the financial world, is they're looking for a 2-point reduction in interest rates. And I've talked to people every time I talk to somebody in the mortgage business or the financing business, and I start to mention 2 points, you're crazy, right? So I may be crazy, but I think if we had a 2-point reduction where we had long-term 5% mortgage interest rates, I think the economy is going to grow at a tremendous growth. And I think Mohammed pointed out, and again, smart guy. He works with Allianz. He was, chairman of Cambridge College, of the economics department there. You know, I think interest rates are the missing link. And I think if we get those down, it's really going to free up people to go borrow money from the banks. And if the banks start to lend, and at reasonable rates, I think you're going to see tremendous expansion. I think the entrepreneurial nature of our economy is gonna continue to help us grow and expand. Um, it's historical growth. When you look at what happened, right? 2.3%, 3%, 2019, 2.8. We were having it. Look, this is a 2017 tax cuts, right? Happened here, right? We have a 0.7% increase in GDP. It cooled off a little bit in 2019, and then we had the pandemic. Who knows where we would have gone, but the economy was going pretty damn good after those tax cuts, right? Um, and the projections right now for GDP at 1.6%, I don't believe them. Okay. So I just don't believe 1.6% in 2026. Okay. And Federal Reserve says 1.85. I don't believe it. Not with this. If the interest rates are adjusted, right? I just, man, I just really feel like the government can't really do anything else than it's already done. It's like the Trump administration has put these four things in place, or trying to do the fourth one. The first three, what else are they going to be able to do? Right? The only other thing they could do is go back to the pandemic era of giving away free money, right? PPP loans and ERCs and all that other stuff that created so much money in the economy. They're not going to do that, right? It's so much easier to use the economy itself and the inherent entrepreneurial nature of U.S. business to grow, right? So, I mean, Tax Policy Center says 4.6, 4.6, 4, a 0.4% uplift from 2026 to 2034 by the one big beautiful bill. Yale says 2%, right? One big beautiful bill, or 0.2%. So these guys are just, the Wall Street notes that, the one big beautiful bill is 2.2 to 0.5% growth in GDP by 2026. GDP could be 1.1% to 1.2% in 2027. But when you take that and combine it with the deregulation we talked about from the Reagan eras, right? That's not included in these projections, right? It could be a very, very interesting, because I'm really very, very bullish on 2026, 2027, right? And I think they're crazy. And my opinion, it's crazy to say 1.6% in 2026 and 1.8% to 1.9% in 20. I don't believe it, right? Because 2017 to 2019, it was 2.2 to 3%. So why are we going like so low in terms of the GDP growth? Especially when you layer on the tariff situation and the opportunities there, and then the labor situation from the closing of the border. It's going to be kind of interesting. So in summary, right? Tax stimulus, pro-growth reform, permanent QBI, 23% QBI deduction, 100% bonus depreciation, boost capital investment, right? Some business investment responses are showing 3 to 5% higher among small and medium enterprises. Deregulations, it's just big government actions geared towards growth, right? So, whoops, too far. And interest rates, and hopefully will undo this very cautious monetary policy, right? And can hopefully get, like, and one of the mortgage guys I was talking about the other day was like, rates peaked at 5.5 to 5.25 to 5.5% in 2023. That's the core rate, right? And if banks can get back to 2 points lower to 3%, to where we can actually see mortgages in the area of 5 to 5.5, because the banks need, so have the core rates go down to 3.25 to 3.5. The banks get their 2%, which allows it to go to 5.25 to 5.5. We get in those rates, I think we're going to have a tremendous real estate boom in this country, which is terribly needed because we've underbuilt for so long. One of the reasons housing prices are so high because there's not enough supply. So that's my position. Okay. That's the way I read kind of the tea leaves from everything that's happening. It's not just the one big beautiful bill, but the one big beautiful bill lets us keep, as business owners, keep more of our money to invest in the future. So that's pretty exciting. I have written a book on small business profits. If you want to go ahead and download that, you can scan this QR code to get the book downloaded. And then you can give us a call and we can schedule you for additional assessments moving forward. Okay. So thank you very much. I appreciate your time and attendance. Hope you found this good. My bottom line is I think 2026 is going to be good, and I think 2027 is going to be even better. I would expect GDP growth in the high threes, mid 3s to 4% range with what we're looking at. Hopefully inflation will stay under control. But I think there's a lot, like quite honestly, Mohammed said, there's a lot of exciting opportunities coming on down the road to productivity. And if AI, robotics, and everything else like that, there's a lot of good opportunities for us in the United States to continue to build our economy. So thank you very much for your attendance. I really appreciate it. I hope everybody has a great weekend.